Every financial collapse tells two stories. One is the tragedy you hear about. Families losing their homes, workers laid off by the millions, entire communities devastated overnight. The other is the story they don't want you to know. While ordinary people watched their life savings vanish, a select few were quietly positioning themselves to make unprecedented fortunes from the chaos. These weren't lucky accidents or random windfalls. They were calculated moves by people who understood something most never learn. Every crash is also the greatest wealth transfer in a generation. The 1929 stock market collapse and the 2008 financial meltdown are remembered as disasters that brought nations to their knees. But for those who knew what was coming, they were goldmines. While newspapers reported on soup lines and foreclosure notices behind closed doors, certain individuals were collecting profits that would make them some of the richest people in history. The brutal truth is that financial catastrophes don't destroy wealth. They redistribute it, and the redistribution always flows in the same direction, from the many who trusted the system to the few who understood how to exploit its weaknesses. This is not a story about luck or timing. It is a story about information, strategy, and the cold calculation required to profit from human misery. Because that is what these crashes really represent. Not natural disasters, but engineered opportunities for those positioned to benefit. The same patterns repeat across centuries. The same types of people win, and the same masses lose. What changes are the tools, the scale, and the sophistication of the schemes. But the fundamental game remains identical. Mains. Let's start with 1929 because that crash created the playbook still being used today. In the months leading up to Black Tuesday, while newspapers celebrated the endless prosperity of the Roaring Twenties, a small group of insiders were quietly preparing for disaster. They had access to information that ordinary investors never saw. They understood debt margin, levels calls, and market manipulation in ways that retail buyers could not. And when the moment came, they were ready. Jesse Livermore stands as perhaps the most notorious profiteer of the 1929 crash. Starting as a humble chalkboard boy at a brokerage firm, Livermore had spent years studying market patterns and developing what would become a legendary ability to time market moves. But 1929 was different. This wasn't just about reading charts or following trends. Livermore built massive short positions throughout early 1929, using more than 100 different stockbrokers to hide the true scale of his operation. By spring, he was down over $6 million on paper. But Livermore wasn't gambling. He was waiting. When Black Tuesday arrived on October 29th, Livermore's strategy paid off in spectacular fashion. As panic swept Wall Street and stocks plummeted, his short positions generated approximately $100 million in profit. To put that in perspective, $100 million in 1929 would be worth over $1.5 billion today. Livermore had turned the greatest financial disaster in American history into the greatest trade of his lifetime. The newspapers called him the Great Bear of Wall Street. The public blamed him for causing the crash. Death threats poured in, forcing him to hire armed bodyguards. But the money was real and it was his. Livermore's method was elegantly simple and brutally effective. Short selling allows you to profit when prices fall by borrowing shares, selling them at current prices, and buying them back later at lower prices to return to the lender. The difference is your profit. While millions of Americans watched their investments evaporate, Livermore was collecting the difference between the peak prices and the crash prices on an enormous scale. He had essentially bet against the entire American economy and won. But Livermore represents only one category of 1929 profiteer. Others used different strategies, and some proved more sustainable. Joseph Kennedy Sr., the patriarch of what would become America's most famous political dynasty, took a more conservative but equally profitable approach. Kennedy had made millions in the unregulated stock market of the 1920s through insider trading and market manipulation, practices that were legal at the time. But unlike Livermore, Kennedy didn't bet against the crash. He simply got out before it happened. Kennedy's strategy was preservation rather than speculation. While others were intoxicated by the seemingly endless bull market, Kennedy began liquidating his stock positions in early 1929. He sensed trouble ahead and chose to preserve his wealth rather than risk it for additional gains. When the crash came, Kennedy wasn't holding worthless paper. He was holding cash. And cash, in the aftermath of a stock market collapse, becomes incredibly valuable. Kennedy used his preserved wealth to expand into other industries, including Hollywood, where he became a movie mogul. His early exit from the stock market before the crash allowed him to build a fortune that would fund his family's rise to political prominence. Bernard Baruch, another legendary investor of the era, followed a similar path. Baruch had made his fortune as a financier and speculator, but he possessed something many of his contemporaries lacked: the discipline to walk away. In early 1929, sensing that stock prices had become disconnected from reality, Baruch began selling his positions and moving into safer investments. When the crash arrived, Baruch was not only protected, but positioned to buy quality assets at fire sale prices from desperate sellers. This pattern of early exit and preservation would prove to be one of the most reliable strategies for surviving financial crashes, but it required something that most investors lacked: the emotional discipline to abandon profits during what appeared to be an unstoppable boom. These men understood that markets move in cycles, and they positioned themselves not just to survive the inevitable downturn, but to capitalize on it. The aftermath of 1929 revealed the true genius of their approach. While the majority of Americans saw their wealth destroyed, these early exiters found themselves in a buyer's market unlike anything in history. Quality stocks, real estate, and entire businesses could be purchased for fractions of their former values. Desperate sellers flooded the market, and those with cash could acquire assets that would generate wealth for decades. The crash had created a fire sale of American, and only prosperity those who had preserved their capital could participate. But the 1929 crash also demonstrated the temporary nature of crisis profits. Livermore's spectacular gains proved fleeting. Despite his legendary trading skills, he eventually lost most of his fortune through subsequent bad investments and personal extravagances. By the time of his death, his liabilities exceeded his assets. The lesson was clear: making money during a crash was one thing, but keeping it required entirely different skills. The sustainable winners were those who used crisis profits to build diversified, income-producing assets, rather than betting everything on the next big trade. Fast forward to 2008, and the patterns repeat with sophist modernication. The housing bubble created opportunities for a new generation of crisis profiteers, but their methods were far more complex than anything available in 1929. Instead of simple short selling, they used derivatives, credit default swaps, and other financial instruments that most people had never heard of. The scale was also unprecedented, where 1929 profiteers made millions. 2008 winners made billions. Michael Burry exemplifies this new breed of crisis profiteer. A former neurologist turned hedge fund manager, Burry spent years analysing mortgage data and recognised something that escaped Wall Street's brightest minds. The housing market was built on fundamentally unsound lending practices. Subprime mortgages were being bundled into securities and sold as safe investments, but analysis showed Burrys were ticking time bombs. Instead of simply avoiding these investments, Burry found a way to profit from their inevitable collapse. Burry used credit default swaps to bet against mortgage-backed securities. These instruments allowed him to essentially buy insurance on mortgage bonds, paying small premiums for the right to collect massive payouts if the bonds defaulted. Wall Street was happy to sell him this insurance, believing housing prices would never fall nationwide. Theically wrong. When the sub-catastrophe prime mortgage crisis hit in 2007 and 2008, Burry's positions generated approximately $750 million in profits for his investors and over $100 million for himself personally. The psychological toll of profiting from disaster weighed on Burry in ways that earlier crash profiteers rarely acknowledged. He understood that his success depended on widespread financial ruin for ordinary families. As he later reflected, his investments did extraordinarily well precisely because a tragedy was occurring. The moral complexity of crisis profiteering had evolved along with the financial instruments, but the fundamental dynamic remained unchanged: extraordinary profits extracted from widespread suffering. The names change, the tools evolve, but the pattern never breaks. From Jesse Livermore's short positions to Michael Burry's credit default swaps, every financial collapse creates the same opportunity for those who recognize it. While the masses trust in endless growth, the few prepare for inevitable collapse. While institutions promise stability, the wise position themselves for chaos. The next crash is not a question of if, but when. And when it arrives, the same two stories will unfold again. Tragedy for the many, fortune for the prepared few. History doesn't repeat, but if you don't understand it, it will crush you all the same. If this opened your eyes, hit subscribe. The patterns are always there if you know where to look.